Hey guys, another quick video on an article that I came across about two days ago. Um, this is from Jeffrey Gunlock. So he's basically a billionaire investor, uh, known as the Bond King. Very very well known guy. So what he's saying is, within 18 months we're going to see a crack pretty hard. So he's referencing the U.S. stock market. So he's pretty bearish on the stock market, and he's basically saying that, well, the best sort of opportunities are going to be to buy them in the future. And there's basically, it's the major driver is really going to be a weakening dollar, which I thought was really interesting. And he goes on to say, I actually think owning 25% gold isn't crazy right now, nor do I think owning 25% cash is crazy. So basically, half of his portfolio could be um, in very risk averse asset classes, so cash and gold, which I thought was really interesting. And he thinks, gold is actually a really, really good investment, at the current stage of the economy. And he is bearish on the U.S. stock market. So you do need some assets in the market and the ability to buy stocks when they're cheap. So you can't just own, stocks in the majority of your portfolio, because that just defeats the purpose, in the sense of buying stocks when they're cheap, because you're already over owning them. So that was super interesting to see. And these are some of the Main Street sort of well-known investors out there who are now looking, at gold as a serious investment, and something that's been disparaged for a very long time. To me, it never really made any sense. I think owning 25% gold, along with 25% stocks, 25% in bonds, and 25% REITs, was always a good strategy, because it basically gave you the ability to have diversification and buy asset classes when they're cheap. So in the stock market sort of crash of 08, 09, if you had gold, you had the ability to buy stocks when they're cheap. If you had bonds, and when I mean bonds, I'm talking about treasuries, not corporate bonds. Treasuries go up when the stock markets go down, so you had the ability to buy stocks when they were cheap, and real estate when it was cheap in 2008, 2009. So we may be setting up for a similar situation over the next 18 months. I'm not as bearish on stocks, just because the Federal Reserve is printing immense amount of money. And if the stock market goes down 20-30% like it did earlier this year, the Fed's going to be right back up there, printing money and doing all kinds of things that we can't even imagine at the moment. Different ways of reducing the interest rate, and propping up asset prices, because we're in an over leveraged economy, and especially corporate balance sheets with all the share buybacks over the past decade. They're all levered up. They cannot risk a situation where their equities are devalued, and the economy slows to the point where the debt service becomes an issue. That could lead to major defaults and bankruptcies. And the Fed knows that they're not going to risk it, because there's just too much leverage in the system. I also want to give a quick update on where asset class returns are year to date, which I thought would be good. I think most people don't really think about this, and I spend a lot of time looking at this, so I thought it might be helpful. So I'm looking at the last sort of line here at the bottom of 2020. The numbers are valid till the end of September, so it's a little 2 weeks outdated. But U.S. stocks, that's the second column, up 5.42%. We were down significantly earlier this year, so we've had a nice comeback there, but not up much, kind of treading water. If we look for U.S. bonds, so U.S. total bond market up 6.92, so bonds have done better than stocks on average. not a bad return. That's the total bond market. If we look at the 10-year Treasury, which is what I like to invest in our portfolios, it's up 11.44, a lot better because there's a lot of risk aversion in the market, and there's been some damage in terms of credit spreads this year. And two asset classes that most advisors do not invest in any reasonable size for their clients, real estate and gold. So REITs were down 12.79%. And that's driven by really the coronavirus. It really hit commercial real estate quite hard. And you'll see gold up 23.95, and precious metals, which we like to include in our portfolio, is a mixture between gold and silver, up about 33.74%. So really, really large outsized returns coming from precious metals this year. Something very, very interesting to see in 2020. 2019, interestingly, precious metals were up 39.79, literally almost 40%. And you probably never even knew about it. And I think this is going to become a real trend, that precious metals are going to outperform U.S. stocks and definitely bonds. So really something interesting to look at. So I did some quick numbers, just back of the envelope, to see, what type of returns, did a 60-40 achieve year to date, and what what we call the complete portfolio, what that's doing year to date. These are approximate numbers based on the asset class returns we just looked at. So a 60-40, a typical portfolio that most people would be in, is up 6%. The balanced portfolio between stocks, bonds, real estate, and precious metals, what we call the complete portfolio, up 8.3%. So doing significantly better this year, and I think that's going to continue looking out, because there's just no ownership of precious metals and real estate in the average portfolio. So yeah, that's it for today. Just thought that was interesting. People are beginning to look at precious metals and gold in terms of the big sort of mainstream asset managers beginning to consider adding that to their portfolios. And if they do, there's a lot of upside in precious metals, definitely. In terms of invested assets in the U.S., I think it's less than 50 basis points of the invested assets are in precious metals. I mean, it's really, really nothing. So if you had a drive into that asset class driven by higher inflation or risk aversion, just weakness in the dollar, something that Gunlock mentioned, which is going to drive weakness in the U.S. stock market but benefit precious metals, you may see vast outperformance when we're comparing a regular 60-40 to what we call the complete portfolio. Okay, thank you.